Big tech announcing a slew of layoffs this year as Amazon, Twitter, other companies that aren't necessarily big tech have announced that they're paring back their workforce. Many more announcing that they are slowing hiring or freezing hiring for the time being. For more on this, let's bring in Mark Fields, former CEO of Ford and Hertz. He's now a CNBC contributor, and BET founder Bob Johnson, founder and chairman of RLJ Companies and chairman of Retirement Clearinghouse. Gentlemen, good evening. Bob, should we be worried about our jobs in this economy? And how are we going to be able to determine what's coming?
Thanks, John. I'm not sure on the micro level that individuals should be worried about their job. I think on a macro level that in order to tame inflation, you've got to do something to spending from the standpoint of fiscal policy, and you've got to have a Fed that's going to figure out a way to execute the trade-off between inflation and controlling unemployment. And right. That's the trick of it. You're going to control inflation. You're going to somehow see a rise in unemployment. The question is, the Fed has two charges. One is controlling inflation through monetary policy, and the other is keeping a level of employment and controlling unemployment in the best interest of the people of the country.
And Fed Chair Powell, though, is talking.
That's a trick that has.
Yeah, he's talking about pain, which means that they want to see fewer job listings. They are willing to see unemployment a bit higher. And Mark, this makes me wonder at sort of the micro level, when people at home who are concerned about their jobs and their raises, perhaps, what kind of an era are we headed into, and to what degree is Q4 and how much consumers have the power to spend? How pivotal is that going to be in what happens at the beginning of next year?
Well, I think you're starting to see consumers be stretched a little bit. They're trading down on things like accessories and clothing and things of that nature. But also at the same time, when you look at their balance sheets, listen, compared to obviously the last recession and pre-COVID, consumers' balance sheets are in pretty good shape. That being said, when you look at the savings rate, it's down to about 3%, which is obviously below the COVID-induced high savings rates, but it's actually down the lowest it's been in the last decade or so. You're seeing credit card balances go up significantly. And, when you have this mixture of declining consumer confidence, the fear of recession, because everybody's talking about it, that's all they hear all day, and these rising interest rates, the consumer is going to start to feel it. And that's why you saw in a lot of the third quarter earnings calls, a lot of CEOs said, listen, we have to revise. We're revising our revenue and growth objectives, and we're going to start working on costs because they're very focused on maintaining margins. And a lot of that in many businesses comes down to people. Yeah. And that's why you're seeing a number of layoffs. So, you're going to see a level of unemployment rise. But I think, as Bob said, it's going to be necessary to tame inflation. That being said, consumers are starting to pull back with the exception of travel and entertainment, but even that's going to come off its sugar rush, just like the durable during COVID.
And Mark, Qualcomm, where you're on the board, announced a hiring freeze after we saw that the sales of smartphones, the projections are coming in lighter than a lot of people. So when consumers spend less, companies hire less. Bob, my question is, what do you expect to happen coming into 2023 if we continue to see consumers spending less and maybe even less than is expected right now? Bob, I don't know if you can hear me. So, Mark, your take on that, kind of drilling down more on what you were just saying. If consumers don't spend as much, then companies not only don't hire as much, but perhaps intensify layoffs.
Yeah, I think as you get into 23, obviously all the businesses are very focused on the leading indicators, looking at their order banks, looking at their sales pipelines, things of that nature. And I think, we haven't yet, John, felt the full impact of the Fed increases. Even the first one, which was about 6 months ago, as you know, it takes about 9 months for it to hit the economy. So I think in the first half, as we get into 23, I think you're going to see a lot of businesses continue to be very focused on their cost structure, trying to maintain their margins, because a lot of the CEOs know that, listen, the way you get valuations up over time is you grow your top line and you grow your margins. And in an environment where the economy is going to be bad and your growth is probably going to be negative, you at least want to maintain your margins. So I expect these companies to continue to hack away at costs as we get into 23.
Okay, Bob, back to you on this one. Part of what I'm watching as we enter into the holiday period is these inventories, right? Not only of finished goods, but of things like chips that, companies bought a bunch of. They haven't necessarily built the devices yet, and they're already seeing, okay, spending is slowing down. We've got an overhang. Does that mean if demand continues to slack off that we're in for some pain in the labor market for the workers at home? I know overall, the economy, you're saying, hey, we need to see some slack in the labor market, but people like at the individual level, people like to have jobs.
Well, that would naturally follow if consumers, which make up approximately 70+% of the economy, are reducing their spending, then as a result of
it looks
they're
like
going to need fewer workers.
Bobby,
and that unless we can come up with a balance, you can be headed towards something called stagflation, where you're not getting productivity and you're not getting revenue growth, and yet at the same time you're seeing the labor force fall off. So that's the challenge of what's going to happen when you're in this kind of market, this kind of economic environment.
And we've seen in the case of Japan how painful that can be if that sets in. Mark, from an investment perspective then, how do investors, you think, shift their position or at least think about how they want to be positioned heading into 23 based on what we're seeing, yes, in overall spending, but also in this labor environment?
Well, obviously, they have to do their homework and they have to be very selective. I mean, it's really important to be, I think, for investors to be focused on, obviously, those companies that are leading in their particular sectors, those companies that have explicitly stated, as we work on costs, here are the things that we're going to continue to invest in to give us a competitive advantage in innovation over our competitors. So I would look for those companies that, clearly articulate the things not only that they're going to do, but the things that they're going to stop doing. Secondly, I think you have to look at sector specific. I mean, when you look at the technology sector, for example, the valuations have been so decimated over the past 6 to 9 months. There's a lot of good value in there, but it really comes to investors having a point of view on the big macro factors of what's going to drive consumer and business behavior in the next 12 to 36 months. So I have to be very selective, but there's going to be a lot of opportunity as we get into 23, because as the stock market looks 12 months ahead and not in the current day.
At least it should. Thank you for your insights, gentlemen. Mark Fields, Bob Johnson.